Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at Twitter, get a bunch of information, news from there. I'll give you my financial opinion. We're going to be looking at a whole bunch of commodity-related information, and there are some questions on there, so I'll answer those questions. If you feel like following me on Twitter, definitely hit me up here. It is at finding_finance if you want to follow me. And I usually do some tweets every once in a while on it. We'll also talk a little bit about the housing starts and some other information. So we've got here this guy Warren. Looks like he says uranium bulls will not tell you this, says Warren. I guess he's got some bear points. They're not even that good of bear points in my opinion. Basically what he's saying is that the cost to come online, $75 or so. You know, there's all this supply out there, and the big takeaway, at least my opinion on commodities, is the business cycle. And I don't know if he talked necessarily about the business cycle. I don't think he did. I did not watch the whole clip, guys. I really can't watch some of these things. But I know some people were mad that are in the uranium chat room and all that stuff. Don't let it bother you. You're going to have opposite opinions. And what you can do is you just look at the data and you ride through the commodities bull market because you have a good understanding of the data. It does not matter what other people think unless there's some validity to the structural outcome. And right now, just because you can, eventually, you could get uranium out of seawater, out of the ocean. Problem is, we're not anywhere near that type of spot to be yanking this stuff out of the ocean. We're not even that close to mining any of this. And someone also said that the supply, that maybe we don't have a supply problem, that the deficits, guys, the deficits are what drive inventories down. I don't know the exact amount of inventory out there. Neither does a lot of these other people. It seems like that's something that is highly guarded, is the inventory numbers. And once that inventory becomes scarce and people have to get physical pounds, there's your problem. The timing of it, don't know. And is that even going to matter? I don't think it's even going to matter. I think it deals more with money flows in the commodity bull market and money rotating out of bonds and stocks. Less so about the actual supply-demand balance. Yes, the supply-demand balance will force uranium higher when that does come, but you also have the money rotating around in the system. Here's the DXY. John's been posting this thing. We've got a trend line, and then he posted one of these other trend lines. Are we at the top of the DXY? I'm not claiming that we're at the top. There's a lot of momentum behind this. And I usually don't jump out in front of that momentum. But I do think eventually this DXY will turn, and that's going to be a tailwind behind commodities. The exact timing of it, I don't know. A lot of people think that they can time this stuff to the T. I don't think they can. And what I do is I kind of just accumulate when things are cheap. I do think that oil and all these other commodities can still go higher with a increasing DXY. But when that DXY does turn and these things are priced in dollars, I think that's going to give us an ultra boost to the upside. And that's probably what they don't want. They don't want the dollar to fall because then the Federal Reserve does not want the dollar to fall because it's going to increase inflationary pressures. But that's what we've got there for the dollar, the DXY, I should say. Here's one. It says, after the 2000-2008 crash, it took the S&P 500 25 weeks to bottom. After the U.S. 10-year, 2-year had bottomed and uninverted. We haven't even found the bottom in the inversion yet. Note, the inversion is a lot lower this time around as well. So what he's talking about is this: the yellow line here is the 2-year, and it's still it's still inverting and continuing to invert. And at some point, when you have to worry is when it uninverts. When it uninverts and comes back the other way, that is when you could potentially get your crash. So you uninvert, you come the other way, and now the crash is likely to happen. You uninvert and it comes, and he's got, roughly 762 days or 25 weeks from the uninversion and then the eventual crash that happens. So it's the uninvert portion going upward where your stocks go and crash lower. That crash hasn't happened yet. We are, I think, anticipating a crash, and I think it will come, but we're still inverting. And usually that inversion still means that everything's okay. And then once you bottom out and start to uninvert, that's when you worry. But we're not there yet. Here's one. It says, we will not initiate a renewed open position in gold until this happens. And basically, he's just taking a long-term downtrend line. We have not broken through that downtrend line. We do have support where the dotted line is through previous trading. Once we break through that downtrend line, this is the XAU to stock ratio. Then we can break. And this is what I follow. It's the XAU to stock ratio. And once it breaks out, then it's game on for gold and silver mining companies. But right now, we are still early. I do think it's tied to this guy over here. Usually when it does well is when this goes sideways and uninverts. That is when gold and silver do well. So we are very low. We're still compressing. But I do think that we are getting very close. I'm of the type where even though I may not get it perfect, I would still be buying before this turn all through here for a good while. Even if it came down here and I started buy all through this entire area, I cost average in. That's the way that I do it. So I'm early. I'm always early. That's how it works. And I just kind of wait in it in the asset if it's cheap, which it is very, very cheap. This is crude oil. Will crude oil catch up to the 10-year yield? And which way is this thing going to go? Is crude oil going lower what's going to turn the 10-year yield lower? It's possible. And we could also see this turn lower and this turn higher this winter. Maybe it's a little further out than where we are today, but there's a strong correlation between the 10-year yield and the price of oil. The price of oil is highly correlated to inflation. Inflation front runs the 10-year yield. And if you notice, usually oil outpaces the 10-year yield. So is this 10-year yield going to head lower, or is crude going to snap higher? We have a large disparity between these two, and that's usually when you have an opportunity. Which way is this going to snap? Is the yields going to snap lower, or is crude going to snap higher? We had a large disparity here as well, where crude had a pullback, the 10-year yield pullback, and then we rocketed higher. So we'll see which one. Yellen thinks that crude oil, and same with Powell, is going to go higher this winter. Not that that really matters to me. I'm not making any decisions off that, but that would explain that this would snap higher for crude in the short term. Short term being this winter. It says, don't get lost. This is the map for uranium. The fly zone is where it flies higher. We have a double bottom in this ratio. This is the Camco to S&P 500 ratio. The S&P 500 has been it's under pressure, guys. It is definitely under pressure. We've seen a break of this ratio out of its kind of a long-term type bottoming pattern. And we are entering what is known to him as the fly zone. The fly zone is where we could definitely get some liftoff here, at least in this ratio. So that does not necessarily mean that Camco is just going to go straight higher in dollar terms. What it means is that we are going to see an outperformance of Camco in relationship to stocks. Stocks could go down while Camco goes slightly higher or sideways. And this ratio would still dramatically shift. I know a lot of people are waiting for this big boom in uranium. They want the launch. I am patient. I'm not as leveraged to the sector as maybe some others are. My allocation isn't as large as others. I'm probably at like 10 or 15% of the portfolio of all my portfolios, something on the lines of that, maybe a little bit more, maybe 20% at most. Some people are at like 80 or 90%. That's very high exposure in my opinion, but I do agree that this is a double bottoming pattern. It looks good, and hopefully we can get that lift off here shortly. Yeah, I won't go over that one. Precious metals sentiment is so dead in the water that some quality small mid-sized producers are trading below cash minus debt value, meaning you get the company and its assets for free. It's been a while since I saw that, really. The more hated the sector is, the better. The larger the opportunity, the more hated a sector has to be, and you're going to have to be a contrarian to invest in this stuff. And right now, precious metals is a very good spot to be looking at. Because of whatever these metrics that you want to measure it by, it is dirt cheap. But we just haven't broken out against either gold or against stocks yet. But it is cheap. It says extreme bearish sentiment alert. Gold loses status of haven. Front page of Wall Street Journal business section. Be greedy when others are fearful. And right now, people are fearful. Gold loses status as haven. And I just kind of walk in whatever's cheap and I just continue to buy it. That's been my strategy. I have a long-term, 5-10 year hold. If the structural market conditions are ripe for these things to go higher, I continue to buy them and I continue to hold what are of really good value. Here's outstanding speech by Aramco CEO on energy ignorance, the exhaustion of spare capacity, and the ongoing lack of sufficient capital investment. We remain bullish, says Eric. And I'm just going to touch on these highlighted ones. It says, we're flashing red for almost a decade in terms of warning signs in the global energy policies. It says, in fact, oil and gas investments crashed by more than 50% between 2014 and last year. From 700 billion to a little over 300 billion. The increase this year are too late and too little. Because when you shame oil and gas investors, dismantle oil and coal-fired power plants, fail to diversify energy supplies, especially gas, oppose LNG receiving terminals, and reject nuclear power, your transition plan had better be right. The plan was just a chain of sand castles that waves of reality have washed away. They're talking about the current energy policies and what they've put in place, and their plans have been garbage. These are the real causes of this state of energy insecurity. Underinvestment in oil and gas. Alternatives are not ready, and no backup plan. But you would not know from the response so far. As for conventional energy buyers who expect producers to make huge investments just to satisfy their short-term needs, they should lose those expectations fast. And diverting attention from the real causes by questioning our industry's morality does nothing to solve the problem. Oil inventories are low, and effective global spare capacity is now about 1.5% of global demand. Our global spare capacity is being eaten away. This has the likelihood of getting absolutely, we've never been in this type of scenario where global energy markets are this tight. We could see prices skyrocket if we actually, if China opens up, SPRs dwindle down, and we're going to be at an area where we have even less inventories, as our inventories were released to control and manipulate prices. It says, but when the global economy recovers, we can expect demand to rebound further, eliminating the little spare oil capacity out there. And by the time the world wakes up to these blind spots, it may be too late to change course. That is why I am seriously concerned. We are dancing on the edge of capacity eating through inventories. Here's one. It says housing starts higher than last month, and still a strong number for starts, 1.575 million starts, which is above average. Housing permits did fall some, but still above average. Patience. And we've pulled on back, but the last month we've come back up higher. And I'm just trying to see, are we going to go higher or lower from here? I don't know. We're going to have to find out. The overall structural market conditions for the demographics and the millennials are strong for an increase in home starts. The interest rates have been on a tear higher. So we've got the demographics that support more new homes being built, but we have the affordability of the worst it's ever been. And those are clashing against each other. What are housing starts going to do? That's what we're waiting to see to find out what these starts are going to do. These starts are a form of increased credit in the system. That's why I look at this so much. We are still in an expansionary phase. Is this going to travel higher or is it going to travel lower? I don't think anyone knows that. We're going to have to find out and see if the affordability is going to impact the housing starts. A lot of people think that's going to be the case. That necessarily has not been the case in the past. We've seen increasing interest rates along with increasing home prices so long that the demographic completely overwhelms the demand-supply scenario. What that means is people have to be priced out of homes. And that's what's happening. The affordability is definitely going down, but it's going down from the interest rates, maybe not so much from bidding wars against each other. So we'll see where this thing heads. I'm being patient watching the data. We have seen a decline in permits as well. So we're seeing that decline. We could very well go lower. And if we lose the housing market, or the housing starts, I should say, that is not a good thing. And we're going to have to take other measures to get out of the markets given this information. So if we see the housing starts start to really fall, and we see our 10 and 2-year curve start to uninvert and start to come back up, that might be the time to either take profits or take a little bit different stance on raising cash in the portfolio. But at this time, I'm still, there's no reason to be panicking. There's no reason to sell out at this time, in my opinion. And we will definitely find out, that data over the next year. Coming up here, baseload energy intersects best drill hole to date, 0.9% over 31 meters, starting at 69 meters of true vertical depth. So good job for baseload. Keep it going. Define that deposit and come out with some results of how big this thing is. I also want to talk on failing to invest in oil and gas would be the road to heck for America. This is the CEO of JP Morgan, Jamie Dimon, said that the banks refusing to fund new oil and gas projects would be the road to heck for America. An unnamed senior executive at U.S. Bank is considering removing the organization from global green commitments due to legal risk. And Dimon highlighted the fact that the current energy crisis has led to rising emissions due to increased coal use as oil and gas was not available. So all of these ESG measures are actually leading to increased emissions because people are burning whatever they can. And since it's not working in other areas, they're going to be burning wood. They're going to be burning whatever they can burn. Another article looking at this, it says the pullback in natural gas has created an opportunity. Natural gas has retreated from recent highs as European countries are reaching storage level capacities. U.S. natural gas prices have hit a fresh 6-week low, closing at $7.75. The current pullback in natural gas is seen as cyclical, but the energy commodity still enjoys structural tailwinds. I completely agree with that statement. I think that we have an opportunity here to pick up natural gas soon as this natural gas price comes back in this cyclical, seasonal type move. So that is something I'm going to be watching for, especially for the Platinum members on the website. I'm going to be looking for those opportunities in investments, and those opportunities I'm going to share with everybody. So that's what I'm going to be doing for this next couple of months, is looking at these oil and gas opportunities. I think that the increasing 10-year yield, the decline in natural gas and oil prices is an opportunity to accumulate more from a structural long-term basis. So that's what I've got there, guys. That'll wrap it up. Hopefully you guys are enjoying it. Give me a thumbs up. Subscribe to the channel. Subscribe to the website. The Platinum membership is the one. We do have a technical training course today, Thursday, 5 p.m. That's 5 p.m. Mountain Standard Time to join. The Platinum members are the only ones allowed in. I also have question and answer sessions Sunday, 5 p.m. Sunday, Mountain Standard Time for Platinum members as well. All right, guys, we'll catch you next time. This is Finding Value.